how do you evaluate Bitcoin's performance relative to the US-China trade kind of clarity, the UK, air quotes, deal, and kind of what's happening with the economic policy right now?
The adoption is growing rapidly. It's very clear to me, these are not like minor things. And the reason that's important is I think people are finally talking about it as an asset as part of the puzzle.
What's going on, guys? Today we've got a great episode with Jordi Visser. Jordi is a 30-year veteran of Wall Street, and we talk about it all today. We talk about what's going on with inflation, stocks, Bitcoin, AI, and why the market is doing what it's doing when everyone else said it was going to do something else. The whole conversation has one key theme, is that you may be at an advantage if you don't have the biggest brain in the room. No, seriously. Jordi explains it very articulately, and I think that it's a unique way to think about the world. So here's my latest conversation with Jordi Visser. All right, Jordi, we got a ton to talk about this week. The first thing is everyone was super scared about inflation, the tariffs, a recession. People were talking about Great Depression, empty shelves. Like they were all over the place with all this fear mongering. We just got data from April that suggests that sales data is actually still pretty strong, that prices of certain products were actually going down, not up, and the inflation number went down in the latest reading as well. So are we out of the woods? How do you look at some of this economic data that we're getting? Stocks obviously are recovering very rapidly, and they seem to think that the party's on like it is 99 or 2021 all over again. Because of the situation with getting rid of the worst of the tariff situation. So if you kind of go through the last 5 weeks, it started with, hey, we'll put a pause on things for 90 days, but we'll leave China, we'll raise it again. And now we're at the point where we're kind of heading back towards what Stanley Druckenmiller said was a good result. 10% around the board, China may be a little bit higher. So the policy uncertainty has come down dramatically. And so everything on the economy side gets into the divergence that's been there between the soft data, which as we've talked about, it gets this phrase of soft data. It's really people worrying, CIOs worrying. The hard data has remained fine because the hard data is driven by two parts. It's driven by the consumer, which when the stock market was falling down, you're getting a little bit of weakness. Okay, all good. But the other side is the AI trade and AI in general about the spending side. And as we went through the first quarter, all the AI stuff was great. The hard data was good. So it makes sense that once the policy uncertainty goes down, we get the snapback in the S&P. And basically, when you go look at everything now, the fact that we're up for the year, after all of the things that we talked about on here and we went through where everyone's panicking and going through it, now there's still people saying recession. The reality is there is no recession. I'm happy to say that. And I'll keep saying the same thing I said. The definition of a recession is a historical thing that most economists and politicians and everyone learned in school. They do not exist in the framework of today's world. So as I look at all of the data points that are out there, one of the things that I continue to see is a politicalization of economic data. And a good example of this is the Michigan Consumer Sentiment Survey just came out. In it, they ask people about their inflation expectations. Do you think inflation is going to be high, low? What do you think it'll be, et cetera? Democrats have an expectation of incredibly high inflation, 2 times higher than they ever had under Biden. Republicans' expectation is like 1/4 or 1/5, I forget the exact number, of what the Democrats' inflation expectation is. Both of them are sideways to slightly up in the last couple of weeks. But the difference between all the Democrats who think it's going to be this massive number, all the Republicans who think it's going to be this very small number. How do we try to find data that we can trust? Because that survey is 300 people. And I saw somebody online saying, you know, there's 300 million people in America, and we're asking 300 people what their expectation is of inflation. And then if you break it out by political party, it's so skewed. It's basically like 2 different extremes. And so I think I kind of come to this stuff. One of the things the Bitcoiners, I think, got right is they pretty much reject most of the traditional data. And they say, this is wrong. They may not be able to articulate why they think it's wrong, how it's wrong, what a better metric is, et cetera. But it does feel like by rejecting the data points that a bunch of people use, it has led to better decision-making for them. So how do you look at this data and like, do you put weight into it?
Well, first of all, you've hit on a topic which, as I've got more immersed over the last 2 years in the Bitcoin community, let me first describe why I think the Bitcoin community has a big advantage in these times. Number one, this is all social media driven. And I say that in the framework of people blame the media, but really social media is, if you want, whatever you want to see, you can go see. The doom and gloomers, and I never realized this. I mean, I don't have a ton of X followers. If I was bearish, I'd have 5 times the amount.
Of course, you sound smart, but you don't make money.
Yeah, it's like you got to be bearish all the time and go through this. And many macro people that I've been out to dinner with, they have a lot of X followers. They're on Substack. They've got people paying them. They only write negative things. And so Bitcoin people have an advantage that they've been playing from this place of being oppressed, of being morons, of being deplorables. And what I like about it is that just gets you up to not believe anything you're reading. And that's the important thing about making long-term investments. You're living in a world where exponential AI is happening, and the history is just not, it's just not as important. So if you're telling me the tariffs and comparing what happened in the 1800s and 1900s, when there was no news.
When there's horses.
Yeah. Like, how did you find out the news? Of course, there were no inflation expectations. No one actually knew what was going on. We're here. Oh, I'm really worried about inflation because I was on Twitter and the shelves are going to be empty. And Ryan Peterson said there's no boats at the ports and blah, blah, blah. Like, it's nonstop all day long. So I think Bitcoin people just have the ability to look through things and just not believe anything. And one of the key things is to not think you know anything. If you actually believe that you're just following what's happening and you believe that inflation is happening and it's the government's job to make sure that with all this debt, I mean, this is the most simplistic first principle of macro right now. We have a lot of debt. We are not fixing the deficit based on the tax bill and based on the fact that Doge hasn't found anything. And we already backed off on the Main Street versus Wall Street thing. They get it, which means, okay, well, then the easier solution is what we've been doing, which is we're going to try to grow our way out of this by debasing the currency and bonds will be uninvestable. And that's good for Bitcoin. You have to read through the noise, and there's a tremendous amount of noise.
So you're being very kind right now because we're talking on the recording. But the better way to say this is most of the Bitcoiners, me, et cetera, they don't know what they don't know. They don't know anything really, right? And on one hand, I would say that is true for a lot of things in the economy. If you go and look at Bitcoin, Bitcoin was an asset that you shouldn't have invested in based on the old way of looking at the world. And I've previously said that I think that Bitcoin is an intelligence test, but not intelligence in the sense of are you smart or are you not? Do you have the intelligence and the intellectual humility to update your worldview and realize the way that people used to look at it is not the world we live in today? So you're dead on with this, right? Mm-hmm. Now, what I also think is very important here is that the Bitcoin crowd, they essentially have grabbed onto this idea of what you're talking about, where the only thing that matters in the economy is that they're going to debase the currency. If they continue to debase the currency, everything else you're being told is a distraction that is trying to shake you out of your investment portfolio. And in a weird way, retail understands that better than the institutions, because guess who was buying on April 9th? The bottom of the market.
Yep.
It was retail. And I saw the smart, sophisticated money going on television, and they had all their charts, and they were pontificating. They weren't crying, but they wanted to. You know, they were saying, yelling and screaming, doing their whole thing. And guess what? If you went on X or anywhere else, buy the dip. These people are idiots, all that stuff. And so to me, what I wonder is, as capital flows more into these people's hands, which you now are seeing all the financial institutions talk about, they're trying to get customers that are self-directed investors, independent investors, retail. They use all different names for them. Those people are the market now. And so, yeah, the institutions have a lot of money, but they're doing things like I saw Jim Chanos recently. He's shorting MicroStrategy buying Bitcoin.
Yep.
Basically, he has a non-directional trade on. He's trying to lock in a premium.
Yep.
Like that's the stuff that Wall Street's doing. What are the retail people doing? They're one direction. They just buy and they keep buying and they don't sell their Bitcoin. And so you can look across these assets. That's why Tesla, that's why Palantir, that's why GameStop. Like, it is a reoccurring theme in society now, is that the retail investor has this persistent bid. And when things go down, they buy, which is actually what you should do as an investor. And I think Wall Street looks at it like, look at how dumb these people are. They're buying right now. But in hindsight, it actually looks like that is the winning strategy moving forward.
So here's the ironic thing about it. And there's so much in what you just said, which I agree. And, we haven't done this before. We've been doing this now for 6, 7, 8 weeks, something like that. I get reached out a lot from people. I saw someone today who's an ex-Goldman partner and thanked us for doing the show. So I'm going to thank everyone for paying attention and going through it. What you just said, and the reason it's important for this, Wall Street has always said there's a Fed put, always. We just have to find the level. The problem is, historically, like the great financial crisis, everyone with debt gets screwed. The market falls down and then the bottom happens, but it's not a V bottom. It's kind of one of these U bottoms. That's what recessions were. The reason I say there's no such thing as a recession anymore is 2 parts. One is the economy has been completely apt and now it's being AI'd. So the economy's changed. Contingency workers, there's just no way for enough people to lose their jobs to have a recession. On the other side, it would be a policy choice to have a recession. So the Fed put is there, but now we're not having U bottoms. First, we were having V bottoms. This one is not a V bottom, people. This is an I bottom. We went down, we went straight back up. Now, the reason the Bitcoin people get it so real, the Fed put is the debasing time.
Yeah, it's always there.
It's always there. And it has to be. And that's why whether Jeff Booth got me down this path before, where if you view the world as 2 components, one is deflationary, which is innovation, and the other one is inflationary, which is the government defending the median worker who is displaced by the deflation, they always have to come back to the puzzle. And that's what we're watching. And that's why the spending has to happen. And the easiest way, other than war, revolution, it's debasing. That's it. And so I think the Bitcoin crowd just gets it more. They have a mentality, because I've talked about this. They have more reps. If you're an online poker player, you're getting lots of reps. It's a lot harder to go to Vegas and then go to AC to put in all that time. Online poker, you can play all day long. You get more reps. You kind of become immune to the losses, and it allows you to stay sharp and look at the next hand. Let me let that one go. There's no tilt. You're reducing that problem. And I think in the markets, they just have more of a comfort of buying when everyone's panicking and putting money to work quickly because they've been through this.
There is something about being terminally online, right? That the speed, the memes, the maybe the volatility, the critiques, like all of this stuff, I was very, very positive on the tariffs. I was very clear that I thought the stock market was going to do very well this year. All of the fear, I think I tweeted at one point, much to the chagrin of many people, that anyone who was fear mongering was going to look ridiculous in hindsight, all this stuff, right? The more pushback I got, the more right I knew I was. Mm-hmm. Because it was basically, there's this consensus. And earlier this week, I talked about the number one signal I knew as to why the analysis of the tariffs was wrong was because all the economists agreed, which meant that dissent had been outlawed, because economists never agree on everything, right? But the second they all agree on one thing, that means that you now actually have left rational analysis, and you now are in a world where dissent is outlawed. And if you say it, you're like almost like being blasphemous. Mm-hmm. And so then that thing is true, right? And we've seen this over and over again the last 4, 5, 10, 6 years, whatever. When I look at the stock market today, I think the stocks are forward looking. Now, people who I have a lot of respect for, who I think are very intelligent, who obviously have made a lot of money and from the scoreboard of success are doing very well, they think that stocks are going to retest the lows. Paul Tudor Jones has said this, a number of other people. How do you think about, okay, we kind of got through that first wave, stocks are back up, not back to all-time highs, but on the way. But there's very smart people saying that we're going to retest the lows. Agree, disagree, or how would you analyze that?
Yeah, no, I disagree with that. I do think stocks will find again some point this year some trouble, but the problem with the stock market is the earnings are growing and the economy's fine. So I think, to be fair to Paul, he said that the weekend before the China tariff deal, and he said on CNBC. I like Paul a lot, so I'm giving him a little bit of credit here for at least saying even if they come down to 50% on China. And now we've got a pause and we're talking about lower numbers possibly. So I think in fairness to him, he said it before that announcement came out, there was new information, you adjust your views and go through it. But Steve Cohen this week talked about a 45% chance of recession and a retest of the lows. You always have to be careful when people come out publicly and say, because if they miss the rally, and they got a lot of people follow him, this would be a good way to get people to maybe take a correction and be able to buy some stuff. I'm not sure he's doing that. He's got bigger things to worry about with the Mets. But I don't think we're going to have a retest. And the reason I don't think we're going to is because the most important factor that came out of Q1 and the most dominant factor going on is the math behind AI. And I just want to bring something up so people realize this, because there's a little bit of accounting arbitrage that goes on with this. It's very unique. So everyone knows the $300 billion of CapEx. But $300 billion of CapEx is a spending number, but it doesn't count as an expense for those companies this year. So it's not like they have to make $300 billion of revenues to offset it. That number gets depreciated over 7 to 10 years. So let's just use 10 years. That means $30 billion a year. So the big question has been whether the Mag 7 can get the ROI on that expense, which I still think is a very difficult thing for them to do. But the $300 billion, they're spending it. So that's a revenue for NVIDIA, for semiconductors, for anything that they're spending it on. So on the one side, you have 300 billion of revenues. On the other side, you only have 30 million of expenses. So without going through the math on it, that's really good profit margin when you aggregate it in the S&P 500. This happened with cloud, and they eventually made the money back. It also happened during the dot-com bubble with the telco. They blew up, but they blew up because they had debt, and eventually it became a bad investment. I still believe that at some point, 2 years down the road, 3 years down the road, this will be a problem for the Mag 7 because the numbers, Sequoia's done work on this. I've gone through it myself. I just don't see how this doesn't become an issue. And one of the things that we talked about before we sat down here, one of the advantages you have in the market that, say, a Steve Cohen doesn't have or a Paul Tudor Jones doesn't have, they're depending on people to tell them what's happening. You get to work with people involved in AI. You're investing in little tiny companies. You actually see how fast these companies are growing. These companies are taking money away from the bigger companies. It's happening slowly, but it's an ecosystem that's growing. So eventually the negative Nellies on the stock market, I think it will happen because we're spending a lot from the Fortune 500 companies. The startups are actually coming back, but it's going to take a couple years. I think you'll start seeing this more and more a year from now. So I don't think we'll retest, but I think once we get through the all-time highs, we'll start to run into a little bit of trouble.
It's interesting you say this because I'll throw a couple of companies out there. Lovable has publicly announced that they're at 50 million in ARR in 6 months. I know that Replit, I'm an investor in Lovable, investor in Replit. They're up, maybe they've doubled, very quickly. If you go and you take a look at maybe a company like maybe a Riverside, which is infusing AI into their product and doing all kinds of stuff, growing incredibly fast, right? We have a company where we have one engineer and myself, two people who have built something. It's growing very rapidly. The biggest competitor has 12,500 employees. Good luck to them. Yep. The data does not look so good for them so far, and it's only been a couple of weeks, right? And like you see this stuff and you start to say, like, okay, the speed is one component, but speed, if you're building the wrong thing, doesn't help you. Speed, if you're building something that can't be monetized, doesn't help you, right? It's also the fact that you can very quickly get to product market fit and then accelerate. And so I think of it kind of like a running back, right? When you hand the ball to the running back, sometimes the running back just runs right to the hole because the hole's there. But the best running backs, they take the ball and they kind of look for the hole in the line of scrimmage and then they accelerate through it. And that to me is what the AI companies are doing, is they're very good at kind of hanging around, trying to build, tinker, find, okay, once they have product market fit, they just accelerate in a way that a company really can't do anywhere else. And so I think the question then becomes, when you see the Perplexities, they're rumored to be raising money at like a $14-15 billion valuation. Obviously, Open AI is raised at $300 billion. These are crazy numbers. It's not just these little small things that are going to take away a little bit of market share. These things are going to be disruptive. I mean, again, we'll see what happens, but these AI companies could disrupt Google, right? I mean, it's like you're going after the giants. Yeah. And one of the best ways that I know to evaluate kind of opportunities is there's this saying, judge people by the enemies they select, right? Or by the competitors they select. And so I always say that if you look at Aptronic or Figure AI, the humanoid robot companies, they're basically choosing to go and compete against Elon Musk and Jeff Bezos, right? That says a lot about the type of company that you have, et cetera, right?
Yep.
Now, on the other hand, if you take a look at these AI companies, they're going after the big guys. And so that Mag 7 kind of issue you're talking about, like, it just feels like people are missing the forest from the trees when they're worried about, like, what is an inflation print? What's the sentiment survey?
Yep.
And you're like, dude, the world is literally shifting in a way where we're never going back to where we were 5 years ago. Today's episode is sponsored by Figure Markets, the place you go to earn yield and borrow against your Bitcoin and Ethereum. Figure Markets crypto-backed loans let you borrow against your Bitcoin or Ethereum with up to a 75% loan-to-value ratio. That's one of the highest in the industry. Whether you're looking to reinvest and double back down into more Bitcoin, cover everyday life expenses, or just have cash on the hand, these loans make it simple. Interest rates start as low as 12.5% with no credit checks, no long applications, and no prepayment penalties. Are you worried about using your Bitcoin as collateral to someone you don't know? Figure Markets is a subsidiary of Figure, the largest non-bank HELOC lender in the United States with over $14 billion of home equity unlocked and founded by Mike Cagney, who founded SoFi. Sign up today at figure.com/pomp and download their app to explore all their offers. Explore crypto, loans, earning opportunities, and more with Figure. Go to figure.com/pomp. Today's episode is brought to you by Maple, the go-to place for on-chain asset management. There aren't many teams in crypto who manage real money the right way, but Maple does. Maple now manages over $1 billion, combining serious finance experience with DeFi innovation. I use Maple because they make it simple to earn real yield, whether that's allocating stablecoins for over-collateralized lending to institutions, depositing Bitcoin to their institutional Bitcoin yield offering, or accessing their premium DeFi assets like Syrup USDC. If you're serious about putting capital to work, then go to maple.finance to learn more. Once again, that's maple.finance. Go check them out today. And so that Mag 7 kind of issue you're talking about, like, it just feels like people are missing the forest from the trees when they're worried about, like, what is an inflation print? What's the sentiment survey?
Yep.
And you're like, dude, the world is literally shifting in a way where we're never going back to where we were 5 years ago.
Yeah. And so two things on what you said that I mentioned this last week, and I'll just say it again. So the numbers you threw out, unless people tape this, or tape it, unless they rewind, go through this and write everything down. If you go to the Stripe keynote speech, Stripe, who's a very important player in this whole ecosystem because most startups end up working on Stripe right away, they went through these numbers. You mentioned Replit. So Replit I used for a little while, and then Cursor came along and I used Cursor. Cursor, I think, is at 300 million AR now. So you're talking about two companies, Replit and Cursor, and the same thing. You've got Windsurf as well. Mm-hmm. These are the things that allow you to speak to create code with having no code skills. So you can create apps in the same day. You can watch this, go on YouTube, spend an hour, you can go create an app without a doubt. Anything you want on your phone, it'll be in HTML, and then anyone can use it. The fact that you can do this means anything built on code is obviously at risk. The number one thing that AI is doing is replicating code. And even though it won't be ever as good as, let's say, the top 2% of coders, you're still replacing the bottom 80% already, and that number keeps going higher and higher, which means businesses have an advantage. I want to give you a better, not a better visual, a different visual with the running back thing. So a startup company, let's say, has only 3 linemen they have to get through. A Fortune 500 company has 7 linemen. That's the friction of them to move forward. They've got an infrastructure. They've got a culture. They've got security issues. They've got things to protect. Big companies do have problems getting through the hole because they've got to change and they've got to adopt, and the adoption has friction, where small companies don't have that kind of friction. The problem is for kind of the middle, let's say 2,000 companies that exist, the small cap and the mid cap companies, they don't all benefit from this. I think the infrastructure plays do. There's plenty of them. But the problem they have is a lot of them had to take out debt. So they've got the problem of higher rates. This is one of the issues that AI has done, which is not, inflation may not be going higher, but it's also at this point not going down to a level enough that rates are going down. So one of the things that's starting to show up is I believe the frictions are hollowing out kind of the businesses that have probably thrived too long that have debt. We're going to lose more of them. The startups are racing really, really fast, and they're going to eat lunch of those, but they're too small right now. But that you can see where this world's going to look like 5 years from now. The S&P 500 companies are going to have a problem with these companies. The question is, will those companies ever go public? You have that answer better than any senior macro person in their 60s by far.
The part to me where everyone got really excited was I forget the name of the company. They were using, maybe it was Kayak or something. They were like slashing customer service costs, like 40% reduction in cost. And everyone was like, oh, look, AI. Which, yeah, it's going to help there for sure. But I do think that there's something like, I know a guy right now, he's in New York. He's building a ERP system. It is called, or I think it's actually self-sex, I shouldn't say. But it's an ERP kind of accounting type system. And his big, like, quote unquote, insight is everyone knows AI agents are going to be a big thing. So the idea that I'm going to have, 5 agents and this one does this one does this, they're kind of like almost like employees, but they work for you and their software. He's like, yeah. But if you build the AI agents into a platform, now they're the expert in that platform. So imagine if every time you went to go use Salesforce software, you got to be on the phone with the Salesforce rep who literally walks you through anything you had live while you were using the product. Be a way better experience, right? Because you would never have questions. You'd never get confused. You'd never get lost. If anything broke, they would fix it immediately, all this stuff. So his big insight is, well, what if you just build the agents right in? Now you have experts on a platform. So your AI agent may be an expert in you. His AI agent is an expert in his platform. Now there's a huge flow of information back and forth, a lot of automation, you can do all this stuff. I have also seen, and they've publicly talked about it, Perplexity is coming out with this kind of browser, Comet. Insane what this thing can do. Insane. And you start to say to yourself, like, there's a compounding that's happening. And I think it's hard for people to see because they hear the anecdotes.
Yeah.
But it's like, okay, the AI agents is a big unlock just for one individual. Then if the AI agent is able to use a browser that's optimized for this and can very quickly go find things, answer things, do actions, etc. But then it's also talking to an AI agent that is inside the softwares that you're using. Like, now you're starting to stack this stuff on top of it.
Yep.
And when that occurs, again, it goes to the acceleration of a company that's able to do it. But I actually think a lot about you can now accelerate the consumer. And this is a part that people haven't really been talking about yet, right? But if I'm able to do more things in a day, ideally, I should be able to make more money in a day. But also, I should be able to consume more things from a monetary standpoint in a day. And so you get this like vortex of efficiency, speed, acceleration that starts to play out, where it's actually going to lead to higher revenues for a bunch of companies. It's going to lead to more personal income, more tax revenue, all this stuff. How are you not long stocks, right? Like, that's what I keep coming back to is like, what is the, 3+ year argument to be bearish on pretty much any asset? I just don't see it. But obviously there's some people who do.
Yeah. So let's convert what you just said, because we spent 5 minutes on just how much AI is going through. So when I listened to a podcast today. I love Russell Napier. He's a historian on markets. And there's 2 things I'm interested in. I do not care about recessions and I do not care about the tariffs. What I care about is the capital flows of the world changing, which I think are happening. And I think there's definitely an impact from the tariffs in terms of repatriation of currencies back to their homeland. That is going to happen. So the dollar will remain under pressure. It has impacts for yields. But in terms of the stock market, to get to your point, there are 2 driving factors in the AI economy for the stock market and for the economy as a whole. Unfortunately, we're in a position where the top 10% are driving 50% of consumption. Consumption is 2/3 of the economy. So it's really hard to have a recession. For everyone listening, for every economist and every person saying a recession's coming, if the top 10% are driving 50% of consumption and the stock market is even unchanged for a year, there ain't no problem. We have $170 trillion of net worth in the country, not creating an issue. When you add in the transfer payments and the entitlements, you're getting a lot of other money for retirees that are sitting at home that are not a part of that 10%. So consumption is fine as long as the stock market's unchanged. On the flip side, and profit margins are growing. So AI is going to continue to grow the profit margins. And so, as I mentioned, you have this arbitrage. So it's really hard for the stock market to go down. Could it go sideways? Yeah. But I don't think that's going to happen for at least the next few years in terms of like the eating away from smaller businesses. And that's where you could be losing some of the pie. But even then, I don't think the stock market goes down. I just think it has trouble outperforming inflation. The $300 billion of CapEx means they're spending money for the AI. This is an AI economy. You're not losing jobs and you're growing CapEx to build out this massive infrastructure, which needs more power. So all of the noise that people are hearing, I agree with you. It's really negative. It's a really bad place to worry about the next 3 years if you need to save money. If you've taken your money out and put it in the bank because you think Donald Trump's going to end the economy, you're betting against AI. You're not betting against Donald Trump. You are literally betting against something which is compounding at a pace that most people can't comprehend. Do not leave the stock market and put your money into cash if we're not going to have tariffs that are going to create the stock market to fall down 20%. I don't think that's going to happen. So
let's talk Bitcoin. Bitcoin rallied from $75,000 up to $103,000, $104,000, $105,000. I think people are like, okay, that drop was not fun, but we're back. And there's some really big numbers out there. How do you evaluate Bitcoin's performance relative to the US-China trade kind of clarity, the UK air quotes deal, and kind of what's happening with the economic policy right now?
So I believe, based on, I do this weekly video and I go through X and I take all of the institutions, governments, countries, sovereign wealth funds that are putting money in. The adoption is growing rapidly. It's very clear to me these are not like minor things. And the reason that's important is I think people are finally talking about it as an asset, as part of the puzzle. And this was very necessary. I needed to see that they were like, you know what? If I put 2 to 5% in, that's actually adding to my portfolio because it was uncorrelated during a very important time. And I think that's one of the most important messages is when it rallied back before the stock market did. And I think this year there will be another leg. So even though I think we're going to get to all-time highs, I think we're going to run into another issue. This one's going to come, as I talked about in the last couple episodes. Second half of the year, the deficit and the debt is going to become an issue, and we're going to see rates move higher. We're in the sweet spot right now, so people hear this. When you go into a regime where people fear a recession, this has gone on almost every year since 2009. Almost every year we have a recession fear. And then eventually what happens is the government stimulates and we rally back. We didn't get government stimulus, but we kind of did because, hey, tariffs are rolled off. So we went from uncertainty to certainty.
And a couple social media posts in there.
Couple posts by the market. Go ahead, go through it. But the problem is rates didn't go down when the market was going down, and they've jumped back up. And we have 30-year yields sitting near the highest level since 20 years ago. And the problem is this has a lot to do with the tariff situation in terms of the repatriation, which is a real thing. It is going to happen. There is no way that the world is not being divided. And Asia has been a huge funnel for our rates being below where they're supposed to be. The second thing is we actually have a problem now that the fiscal and debt situation of the country, the way we started the year, based on the tax bill and based on everything, it's going to be worse. So at some point, rates are going to become an issue, not necessarily for the stock market to collapse. I think people are worried about it. But from the move of, let's say, 4.5 in 10-year rates to 5, when you come out of a recession, fear, rates going higher usually goes on with the stock market going higher. But at some point, probably around 480 in 10-year rates, 485, you'll start to see where stock-bond relationship starts to shift. And I think pension funds, and this is an important point, retail might be buying, corporate buybacks are still going on, but pension funds are now fully funded. They're fully funded because of the rate move and because of the equity move. And I think they will be rotating more into bonds as time goes on because they're fully funded. And I think that's going to become an issue at some yield level.
The 10-year rate, where do you think that we need it to get to?
When you say need it, what do you mean?
Oh, that's for you to determine.
But the good side or the bad side?
I think there's a lot of folks who they know the administration is looking at that number and they want it down.
Okay.
Right. The critics have magic numbers in their head of it going up and hitting certain levels. But I think for the administration and the U.S. economy, is it sub 4%? Is it even lower than that? Where do you kind of see, success look like? What's going on, guys? I hope you're enjoying this episode. Before you continue, I want you to know about a brand new show called From the Desk of Anthony Pompliano. I sit down at my desk every single morning and I explain what I think about current events. It's a great show that hopefully will keep you informed and entertained to a little bit. And so if you go all the way over to the other channel, From the Desk of Anthony Pompliano on YouTube, Rumble, X, and every other platform, From the Desk of Anthony Pompliano is a show that'll keep you informed about all things financial markets, general business, pop culture, and of course, Bitcoin. I'll see you guys over there. Now let's get back into this episode.
Okay, so this is the most important point for Bitcoin this year, and this is where I think the short squeeze is going to occur. So the correlation between the dollar and bonds is going to be critical in the second half of the year. All right, we've had a bounce in stocks. The dollar's barely budged, and rates have stayed higher. So when you kind of go through it, what was the problem this year? Stocks, bonds, and the currency went down at some point. That's going to happen again this year at some point. In my mind, it's going to happen episodically. The reason the bond market is so important for this conversation, other than doing outright QE, which would just be great for Bitcoin, I don't think they're going to be able to do that. I think when rates go higher, this will become a problem for people. I mean, we already have delinquencies. We already have credit card delinquencies and mortgage delinquencies up at very high levels. He is trying to help those people, the people that have been suffering. Now, he can't guarantee they'll have jobs. The tariffs are not going to guarantee that they're going to have manufacturing jobs. None of this stuff is going to happen. But I do think he's committed to doing this, which means somewhere behind the scenes, one of the policies that I think is going to happen is to figure out ways for their especially housing market people that are in houses to get some kind of rate which is lower. Mortgage spreads are at very, very high levels. They've been there really since COVID and the spending. And as Asian repatriation goes on, you're going to see more pressure on mortgages. And I just don't see how they're going to be able to deal with this. New home buyers, same problem. So I think what they're going to have to do is something on the housing side. It's not going to be pure QE. But just like the bank term funding facility was set up for SVB, I think they're going to have to do something. So that's the way I think this rate thing is going to go. I don't think it's going to stop the economy. And that's the main point I keep saying to people is in an AI-driven economy, higher rates does not affect the AI companies on the startup side. And it certainly doesn't affect the Mag 7 at all.
No, and the AI companies, I think you could make an argument. The higher the rates are, the bigger the advantage the AI companies have.
In some ways, their equity multiple side comes under pressure, and this gets back into the comment.
But their competitors have more expensive capital,
exactly.
And you know what I mean. Like
it pushes more people out of the business,
correct.
And that's part of the issue. Is we have, bankruptcies are going up in the country, but startups are going up too. Mm-hmm. It's a weird dynamic, and that's why the AI.
But is it healthy? Like this is an interesting point. Is it healthy for us to have bad businesses go out of business and be replaced by better businesses, better built for the future? I don't want to see any entrepreneur have their business go out of business. Right? There's like an emotional, empathetic, kind of human component where when a business goes out, jobs are lost. That's real people, real families, real income. I get all of that.
Yep.
But if you can kind of take a clinical look at an economy, no different than if you look at an organization, there will be people who say, oh, we shouldn't fire anybody.
Yep.
But the best organizations, maybe they fire 10 or 20% of their staff every year, right? And they rotate in and they continue to improve. And is that kind of what's happening right now in the economy?
So that's technically a recession, and that's what's supposed to happen. I'd rather have a recession this way. This is the creative destruction that's going on. Let me ask you a question. How many hours a day do you use Perplexity or any AI?
AI in general?
Yeah.
Hours, multiple hours.
Now, if you didn't have a job, you could use it more.
Correct.
Okay. If someone loses a job tomorrow, this is just my as someone who went through this, I had to make a decision a year ago when our hedge fund shut down. And I had to go, do I want to go back into the hedge fund industry? Or do I want to be an entrepreneur? And I made the choice to be an entrepreneur. And what I did is I went on Coursera. I took free courses on Python. I did 5 of them in a couple weeks. And then I was able to manipulate AI in a way that I didn't think was possible. I could be doing anything I want right now. What I got was time. And I'm saying this to people, if they lose their job, they can't learn AI going to work every day.
100%.
But if they go home and they're really committed, and you and I believe one thing, I think the reason we get along so well, We're hustlers. We work hard. Like no one's going to stop me from learning anything. I'm 58 years old. I'm going to keep learning for the rest of my life because I love learning new things. You're the same way. Anyone who's out there who loses a job, go spend the time on AI, then go back and look for a job. You'll be in a much more powerful position. I guarantee you.
It's funny to be 58 but look 21. The math doesn't work, right?
Yeah, a lot of drugs.
Last thing I want to talk to you about is going forward. President Trump, his team just went on this big tour of the Middle East. Tons of investment pouring into the United States. I think I saw Howard Lutnick tweet and say $3 trillion was raised during the trip. Now it's not all going to come in this year. It's over periods of time. But it does feel like at the same time the U.S. is hitting all these other countries with tariffs, we also are like the U.S. is open for business. And those countries are taking the United States up on that. Are we making friends? Are we making enemies? Does it matter for the economy? We live in a global world, but it does feel like a lot of these countries are actually doing a lot of business with us that maybe people didn't think they were going to be doing.
Maybe I disagree with you a little bit on this. I don't trust any numbers I hear, especially if they're spread out over 5 years, 10 years.
Yeah, I think that's fair.
The net investment position of the United States, which is a real number, which anyone can go get on their own, is a negative $27 trillion.
Okay.
Meaning the world has already invested in here a ton of money.
Yep.
So we're net against foreigners. They own 27 trillion of our assets on a net basis relative to what we own overseas. So if there's repatriation, which again, if the dollar is weakening, that means those investments, the bogey for being productive assets, it's getting harder and harder. So when people look at this, if the currency is going to weaken, which to me, I don't see a way that the dollar, because they've kind of set it up that they either want it or they're doing it. We have a debt problem. We have a deficit problem. We're not going to deal with it. Dollar weakness does not happen overnight. It's kind of a gradual thing. When bonds mature, right now, there's no QE going on, but every week that the Fed is buying bonds that are maturing. They've got bonds maturing, and then they're only doing $5 billion of QT. So they got to put money back into the things as they're getting cash back, they're maturing. The same thing's going to happen with Asian investors and with European investors. They own US bonds, but if they get 100 billion maturing over 3 months, maybe they're only putting 80 back in and 20 is going back home. I think it's a gradual process. And so I'm not as positive on the whole FDI thing. To me, the problem with this is the AI side. I think people don't realize how democratizing competition is globally for artificial intelligence. We talk about the startup community in the US. There's a startup community in every country on the planet, and we've dominated the tech world. So the reason coding has been our baby, of which if you go through the net investment, most of that is in the Mag 7. If we believe the Mag 7 is going to be under pressure, then there's a repatriation that's happening solely from the revenues being redistributed around the globe because AI competition. For a cursor and replit here, anyone in Europe can go build their own cursor and replit as well. Yeah. And they can have some of the revenue there.
100%. I mean, it makes complete sense. All right, where can we send people to find you on the internet?
They can find me on YouTube. They can find me on X. They can find me on Substack, VisserLabs. And again, for the institutional side, I did 3 papers this week I did one on inference.
AI, yep.
Yeah, and this was a big one. This was the inference moment to me. I'll do a little bit of it on the video there, but they can find it at 22vresearch.com. And that's where they can speak to me and get a hold of me with some of the salespeople there.
Amazing. Thank you so much. I appreciate you taking the time to do this. Last week was a big week for us. This week, I think, might be a bigger week. Let's see what happens. But appreciate all of you guys watching, and we'll do it again next week.